Hello, good morning. I am Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. Let's look at what is happening globally. Geopolitics continues to remain in the headlines. After US administration took president from Venezuela to stand trial in the US, President doubled down on his demand for Greenland to be part of the US from a strategic perspective and security perspective. This created a lot of noise and discomfort within the European counterparts as the Greenland is part of Denmark. Eventually, in the World Economic Forum at Davos, President backed down from the demand of capturing Greenland and is discussing a long-term strategy with his Western counterparts on how to make Greenland more safe from possible incursions from Russia and China. The rate markets continue to move widely across because of various geopolitical tensions. Due to internal strife in Iran, there was also a lot of geopolitics pressure. US president was threatening to send help to ships to Iran to ensure that the citizens of Iran do not suffer further. This rhetoric continues and this continues to remain a flashpoint for the next leg of geopolitical tensions. Rate markets in US were fairly quietish. We saw 10-year around 420 level. On top of that, US Federal Reserve did not move on rates in the January policy where they kept the rates at 350 to 375 range. Overall, the tone of the policy was neutral. Inflation pressures continue in the US, though, and growth is also strong. So from that angle, holding rates was probably the right decision. Coming to India, the latest news has been that US trade deal with India has been agreed upon. US will put 18% reciprocal tariff on Indian exports. This number was 50%, as we remember last year, because of 25% reciprocal tariff plus 25% penalty for buying oil from Russia. India has said that they will stop buying oil from Russia. We have to wait and see how that develops going forward. US is asking India to buy more oil from Venezuela because now they have control of Venezuela economy. The other event which markets were looking forward was the union budget. The union budget was followed a balanced approach where fiscal consolidation was balanced with long-term growth expectations and more allocation for manufacturing and infrastructure projects. However, the market borrowings, especially the gross borrowings, show upward movement where the gross borrowing for FY 26-27 will be about 17.2 lakh crores and the net borrowing will be 11.7 lakh crores. These numbers were higher than market expectations and we have seen bond market yields rise after the budget. Equity markets were also not enthused, but after the US trade deals, they have also recovered substantially. Coming back to rate markets have been under pressure for various reasons, including one, credit growth, two, pressure on rupee because of non-signing of US trade deal, which is now been signed, and three, because of large outflows from equity side on FI selling. Hopefully, after the US trade deal, rupee pressure will dissipate and we may see equity flows and debt flows resume from FI side, as the pressure on rupees probably was keeping investors outside waiting on the fence to see how the situation develops going forward. In terms of markets, again, we are seeing pressure because of higher supply, especially when we look at state government supply and government bond supply. While this year's government bond supply is likely to come to end by March first week, people are worried about what's going to happen in coming year. A 17.2 lakh crore gross borrowing from government is going to put large pressure on a market which is not expecting this much supply. On top of that, there will be supply from state government securities as well. On the other hand, the rate cycle is probably coming to an end. It will be very difficult for the market to absorb such a large supply when the rate market is either in a pause cycle or in a hike cycle. RBI may continue to do open market operations to mitigate the large volatility in market, but we have to wait and see how things progress. The supply-demand gap is large, and it is going to affect yields going forward. Inflation as such has been on the low side. We saw 1.3% inflation in December. Next number will be slightly higher. Overall, the inflation is likely to remain below 3% for FY 25-26. However, RBI has projected in the last policy meeting inflation at about 4% for the first half of FY 26-27. So that may lead to any further rate cuts being either not there or probably one more rate cut is there. We have to wait and see. Overall, rates have gone up in the past 1.5 months. This is partly due to tight liquidity conditions as well increased supply, both on the money market side as well as state government side. We saw 3 months to 1 year rates go up over 7%. And now rates are near levels, almost near levels to where they were last year this time before the rate cut cycle started. So in a sense, markets has reversed all the gains accrued during the rate cut cycle. Overall, we believe that this year would be a tough year for rates as market grapples with increased supply and possibility of rate hikes. We would see RBI being active in bond markets through various tools available to them to try to manage the volatility of market. From a fund perspective, we want to play on the short end of the curve, especially on corporate bond side where the spread over GSEC is attractive. Overall, investors can choose to invest in funds like low duration fund, short duration fund and corporate bond fund. As always, investors should look at their risk profile and their investment horizon before making decisions to invest in debt market products. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.